Okay, so I would start right now with the background of sustainability reporting, especially in the European Union, and give you an overview about the regulations which have to be adopted in the European Union, especially in the European Union, and on a global level, and how these regulations are related to each other. And I want to talk especially about three different kind of regulations for today: the taxonomy regulation, the disclosure regulation for financial institutions, the sustainable finance disclosure regulation, and then the sustainability reporting regulation for the companies in the European Union, the NFRD, the non-financial reporting directive. So, but what's the background of sustainability reporting? Why do the companies have to report on sustainability? And in the European Union, the disclosure of non-financial information, of sustainability information, should help to measure, monitor, and manage the undertaking's performance and their impacts on society. How do companies affect consumers, for example, or the environment as another example? So we have impacts from the companies, for example, on the environment. You can see here on the slide the climate change is one aspect how the companies impact. You all know about that, and the companies should disclose how they negatively impact, for example, the environment regarding climate change. But that's only one factor of sustainability reporting. Environment is only one factor of sustainability reporting. Another factor is then the social aspect, or all the social aspects. How do the companies impact the society in a social manner? You can see here the example for employee protection rights. If we look on the workers in the company itself, or also the companies in the value chain, the workers in the value chain of the company. So they also have to disclose how do they deal with these social aspects. What do they do to care for their worker, for example? And the third factor next to environment and social aspects are the governmental aspects, or the topic compliance. Here we see the example bribery, that we have no corruption and anti-bribery rules in the companies. These are the three aspects of ESG, environmental, social, and governance, of sustainability in the definition of the European Union and the definition of disclosure about sustainability information. And how can we use this information the company discloses about environmental impacts, social impacts, and governmental impacts? We can use it in a different manner, especially with this non-financial reporting or sustainability reporting. The consumer should change their behavior and choose the products and services of companies which act sustainable. Of course, not all of the consumers or customers would look it up in the non-financial information, but we can also find that information on the webpage of the companies or in other communication channels next to the non-financial reporting. So we should change the consumer behavior to reach a more sustainable behavior of the companies, that they change their business model to more sustainability, because the consumer buy more products and services from this company if they act more sustainable. That's one part. And another part is the financing of the company. Another very important part is the financing of the company. So the lending policy of the financial institutions reflects the sustainability behavior of the company. The capital costs of the companies and the access to capital relates to their sustainable behavior. So the companies disclose their non-financial performance indicator, like the greenhouse gas emissions or the waste or the renewable energy consumption, the percentage of the renewable energy consumptions, or the employee protection rights, which are enforced in the company. And the financial institutions decide on that basis if this investment in the company is sustainable or not. So we have this one perspective from the side of the company to lend money, and the perspective from the other side, from the financial institutions, to invest money. So we try to have more sustainable investments from the financial institutions to the companies. And so we also force the companies to disclose their, for example, green asset ratio, their amount or percentage of investments which are sustainable or not. And also the consumer, for example, decide for sustainable investments or not if they invest their money on a listed market, for example. So that's the background of sustainability reporting. How can we use, or do we want to use, this information? Probably a bit more complicated, shown on this slide. What's the political background in the European Union? How is sustainability reporting? How is it reflected in the different regulations and in this action plan on financing sustainable growth? So I told you before that sustainability reporting is used for the decisions about financial investments from the perspective of financial institutions. The financial institutions need the information from the company if they act sustainable or not. So they need to know about some sustainable indicators, and then they can use the sustainable indicators to make their rankings and benchmarking between different companies, and to invest in a more sustainable behavior from companies. So we start with the capital markets in the mid of this slide, the capital markets. We want that all the investors on the capital market give their money to sustainable acting companies. That refers to households as well as to financial institutions. To get to this goal, we start with this number one, the sustainability taxonomy. The sustainability taxonomy in the European Union has gives us some definitions about what is sustainability. If we want sustainable financing or sustainable lending policy, then we have to know what is sustainability, or how can we measure sustainability. And that's what we're going to look up on the next slide. How is sustainability defined in these regulations, or what can we understand under sustainability? We have then standards and labels as the second part, to have it in a bit more detail. And then I don't want to talk about each number here on this slide, but in fact, then we have a lot of regulations which should lead to these sustainable investments. Therefore, we need the information from the companies, how sustainable they act. Therefore, we need sustainability reporting on the one hand. And then on the other hand, we force the financial institutions to disclose their investment decisions, the part of the sustainable investments. And therefore we have this other regulation on sustainable finance disclosure regulations. And on top of both of these regulations, then we have the taxonomy, which has the definitions about what is sustainable. And then one of the tools to have this financial investment is, for example, the credit ratings, which have to integrate ESG criteria and not only financial criteria. So the background is about a financial sustainable growth, and that's reached through the investment processes. Okay, now we identified 3 important regulations. On top of that, we have the taxonomy regulations with the terms and clarifications on the understanding of sustainability. That's the top of it. What is sustainability? That's part of the taxonomy regulations. And when we have the disclosure regulation, or SFDR, on the left-hand side of the slide, Sustainable Finance Disclosure Regulation, which forces financial institutions to, for example, disclose information about their investment processes. So this disclosure regulation is related to financial institutions. And on the right-hand side of the slide, we have the NFRD, which is has to be adopted right now, the Non-Financial Reporting Directive, and we have the CSRD, Corporate Sustainability Reporting Directive, which is in force from 2024 onwards. It entered already into force 2023, but the companies have to adopt these regulations from 2024 onwards. So these directives for sustainability reporting are related to the reporting behavior of companies. We have the financial institutions on the one side and the companies on the other side. Both sides, they have to disclose that information. And what is disclosed by the companies, when we have the arrow in the middle of the slide, is used for the financial institutions, or the financial institutions use this information for their lending policy. So now we have a question in the chat. We have 2 questions in the chat. Is sustainable financing for sustainable actions or long-term continual funding? Sustainable financing means that they lead this capital into sustainable markets. And so on, the companies have the requirement to invest, the financial institutions have the requirement to invest their money in sustainable investments. Or in other words, it's more expensive for them to invest in companies that act not very sustainable, because they have also to pay for the money they lend from, for example, the European Central Bank. It's their funding policy also. They have to lend the money from the European Central Bank, and they also have capital costs. And these capital costs are lower if they invest in more sustainable companies. So they want to lead the financial institutions to invest their money in more sustainable projects. And also all the households or the other investors on the listed markets are informed about the part of their investments. And they also have to disclose the amount of sustainable behavior, which is included, for example, in their funds. So this sustainable financing means a plan, an action plan, which has to be realized over a longer time, and forcing financial institutions to act in their lending policy more sustainable. And then that should influence the companies, because they also want to get money, and to get money with lower cost of capital. And that's what the second question in the chat. Why are these financial institutions required to release data about their investments? It is their private funds that are in use. The financial institutions do also have a social task with financing the different economic activities. And so in what I've explained before, in this value chain of borrowing money from the central bank to the banks and then borrowing it again to the companies, then they have this indirect obligation to act more sustainable. Hopefully that's fine for answering these questions. Is that fine for you? That should give a bit more information about the relationship between these different regulations and the goal that should be reached in adopting these regulations. Okay, we have then transparency and governance of companies on the one hand, and that's we're looking up in the annual reports when we're searching for non-financial key performance indicators. Then the companies disclose these non-financial key performance indicators, like the percentage of renewable energy which is used in relation to the whole energy which is used from this company or group. And then the financial institutions have to use this information to, for example, calculate the green asset ratio, which amount of investments are sustainable, or which amount of investments in specific funds are sustainable or not. So they have to make their investment decisions transparent. Then back to the top of these three regulations, we have then the taxonomy regulation on the last slide on the top, where we have the clarifications and the terms for what is sustainability, because we want to use it in a harmonized, standardized way about all these regulations, where we have one definition for sustainability, and this definition should be the same for financial institutions as well as for companies, for example, and for a lot of other cases too. So we have on top the taxonomy on sustainability, and when we have written down what we think is sustainable in the European Union, we have it again to lead the capital to a sustainable development. The taxonomy regulation consists of a classification system to identify what is sustainable, also for the capital market and also for the companies, which have to adopt their business model regarding that, or good. They want to have more to get money for lower cost of capital, for example. Then a wide range of activities and investments and assets are used to identify what is sustainable. And we have it for also different sectors. We differentiate between different sectors, and that's also what we consider when we look at the annual reports, which kind of sector and which kind of definition is then available for that sector. This architecture of the taxonomy regulation is shown here on this slide, and we differentiate between 6 environmental objectives to decide if business model is sustainable or not. When we have the climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, pollution prevention and control, and the protection and restoration of biodiversity and ecosystems. And the non-financial indicator of a company are resulting from these topics, because we have topics and we have subtopics and sub-subtopics resulting from these 6 environmental objectives we want to achieve in the European Union and on a global level. So we try to measure these objectives in using this non-financial indicator, like the amount of waste, can we reduce the amount of waste, or how can we reduce the amount of waste? How can we have a longer durability for our products? This is part, for example, of the transition to a circular economy. All these indicators, hundreds of indicators we find in the sustainability reports, are part of the 6 environmental objectives in the top, resulting from the taxonomy regulation. And we again find these objectives in the European Sustainability Reporting Standards, which have to be adopted beginning from 2024 onwards. We have then 5 environmental standards. Only 5. We have 6 objectives, but 5 environmental standards, and these standards are related to these objectives. We have only 5 standards because climate change mitigation and climate change adaptation is mixed to one standard, climate change, in the European Sustainability Reporting Standards. They also contain a detailed regulation, what kind of indicators are part to measure climate change mitigation and adaptation, for example, the amount of greenhouse gas emissions, or the goals to reach for example, lower amounts of greenhouse gas emissions for the reference years in the future. Okay, we have then this classification and these different objectives, and we decide if a company acts sustainable regarding these different objectives and adding 3 aspects together. Do we have a significant contribution to at least one of the 6 defined environmental objectives? Do we have a significant contribution? Do we have an engagement in reducing waste? Do we make efforts in longer life cycles of our products, for example, if we then go to circular economy? And if we have the significant contribution to one of these environmental subjects, in addition to that, we should have no significant harm on any of the 5 other defined environmental objectives. So if the situation gets better in one part, for example, climate change, and reducing the greenhouse gas emissions, then reaching this reduction of greenhouse gas emissions should not then make another objective or make it worse to another environmental aspect, where we have, for example, a negative aspect on pollution, and the other case, for example, with solar energy, with for example material which is used there. So do no significant harm test is the second aspect from this taxonomy regulation. I act sustainable if I contribute to one of these environmental objectives, and I do no significant harm to any of these other objectives. And then I add to that I have to satisfy minimum social safeguards, for example, related on the OECD guidelines for multinational companies. So we have a lot of frameworks which are used worldwide, but we can refer on when we define how we want to reach our goals. And we have there some orientation in these frameworks. We have a lot of orientations and frameworks for the different goals in a social manner or in an environmental manner, for example. But to use this taxonomy regulation, when we have not only to use the regulation, we have a lot of delegated acts with more detailed information, for example, the technical screening criteria to identify and concretize these environmental objects, what's part of this environmental objectives. We have a lot of FAQ documents and many further proposals to work on the definition of sustainability in the European Union. So that's the background for the non-financial reporting regulations, the taxonomy regulations. Here we have an example for using the taxonomy regulation for a specific activity, where we have the example electricity generation from hydropower. What's the activity? construction or operation of electricity generation facilities that produce electricity from hydropower. This is, for example, one step from the change from fossil energy to renewable energy. Now, when we have some activities and we have an engagement and we look at this activity which is planned and how it influences the environmental objectives. If we contribute to one of these environmental objectives and do no significant harm to another objective. If we go back to the last slide, we see here that the target that we want to contribute to target 1, the climate change mitigation. Climate change mitigation. That's then here the next part, the technical screening criteria to target 1, climate change mitigation. The activity complies with either of the following criteria. The electricity generation facility is a run-of river plant and does not have an artificial reservoir, for example. And then we have a lot of information about the amount of greenhouse gas emissions for example, when you relate it to specific recommendations or regulations, so that we can quantify how we want to reach these objectives, how we want to classify this engagement in more sustainability. Not to have some information about the measurement. Not only we want to reduce greenhouse gas emissions, but to compare these different alternatives. Okay, we want to generate electricity from hydropower instead of using fossil fuels, for example, to generate energy we could use. And we have now here another possibility, and now we want to evaluate this possibility. And then we can contribute to target 1. And then we look in the next step on the other targets. You can see here from target 2 to target 6 that we do no significant harm to the other targets. And how can we test it for this example? We have, for example, the climate change adaptation. And here we can look in the information of this regulation there, that the activity complies with the criteria set out there. We have a sustainable use and protection of water and marine resources. Now, for example, if we have this hydropower, we can imagine that we could have then an impact on use of water and marine resources. So what can we do to protect then these resources? Here in this case, we have this fish ladders, for example, to have the fish or to protect the fish from the negative impacts the hydropower could then have on this water and marine resources. So we have to look at all of these targets. Okay, that is an example for the classification of activities, business activities from the taxonomy regulation. Okay, that would be the top regulation, the taxonomy regulation. What is then sustainable regarding to this regulation? And it contains also reporting requirements. Yeah? I've told you before that we have reporting requirements resulting from the non-financial reporting directive, from the corporate sustainability reporting directive for the future. But the taxonomy regulation contains also some reporting obligations. Only a little of obligations related to the non-financial reporting regulations resulting from all the other regulations. But we have these indicators you can see here, these general indicators that are not very much related to a specific sector. Especially the companies have to disclose the percentage of environmentally sustainable business activities. Here you see the example for one specific company, but these are also the criteria or the indicator which have to be disclosed. So they have the percentage of environmental sustainable business activities as part of the revenue, which amount of the revenue resides from sustainable business activities, the revenue. And then we have it also here for the adjusted earnings before interest, tax, before depreciation and amortization. so an adjusted earnings measurement. But we have this obligation only regarding the taxonomy regulation for the revenues, OPEX and CAPEX. But we have some additional information from our specific company we look at. So we have 80% of the revenue, but 65% of the adjusted earnings. And when we have to disclose on the companies which are listed on a capital market, not all of the companies have to disclose that. We go more into detail afterwards, but only the big companies are forced to disclose the information in the moment. We'll go back to that afterwards. But what do I have to disclose? The amount of operating expenses resulting from this environmental sustainable business activities. So operating expenses, these are expenses which are not in the area of capital investments, directly impact on the revenue, on the earnings. Operating expenses are, for example, the costs for electricity, personal expenses. We don't have assets we buy and can activate in the balance sheet. And that's the difference to the capital expenses. We also have to disclose the information about the percentage of sustainable capital expenses. And capital expenses are then these the capitalized expenses, for example, investments in machines, in properties. So all these investments where we can activate assets in the balance sheet of a company. So we have a longer life cycle for these expenses. The taxonomy regulation with the definition of sustainability, the test, how can we measure if we act sustainable, contribute to one target and do no significant harm to another target, and when we have little reporting requirements for the companies about their amount, the percentage of their sustainable expenses and revenues. That was the taxonomy regulation. And then we talked about the disclosure regulation, the regulation for the financial institutions. What do they have to disclose? And why do they need some information from all the companies that they can fulfill their reporting obligations? Then we have, on the one hand, entity level disclosures, and on the other hand, product level disclosures. So they have to publish information about the policies here on the left-hand side of the slide, publish information on the policies regarding the taking into account of sustainability risks in their investment decisions. They also have to explain the policies regarding the principal adverse impacts on sustainability of their investment decisions. How are the sustainable factors reflected in their investment process? And also explain how the remuneration policy is consistent with the integration of sustainability risks. So the wage of the management, for example, does it contain of sustainability? Is it measured? The variable element of the remuneration, is it measured by using non-financial indicator, sustainable indicator? That's the entity level of the disclosures. And then we have the product level disclosures. We have, for example, in the middle of the slide, the yellow part, the description of the characteristics and objectives and of the methodologies for the assessment, measuring, and monitoring. Products are, for example, funds. The financial institutions offer. And that could be one of the products. So their lending policies and strongly related to this product level disclosures, for example. And the investment possibilities for example, private investors, like we are private investors. And if you want to have some money on the listed markets, then we probably use some information about the products which are offered on the market. and then we build our investment decision, for example, on sustainability factors. Okay, and when the financial institutions have to disclose how sustainability is reflected in their products, in their funds, for example. An example for that, if you want to invest in products, you can see that a huge amount of products do not reflect ESG, and a small group of products, like impact funds, you have here as an example, are promoted as ESG investments. They have an objective to deliver a positive impact on environment and on social objectives. So the business activities or companies which are part of these funds or invest in these companies or business activities engage in sustainability or sustainable behavior. So at the moment, this is only a small part that we try, or all the regulations aim at the part of these ESG funds or products grows in the future. And then we have a mixture in the middle where sustainability is also considered, but on a lower level. This is the disclosure regulation, the regulation which is to lead the capital into sustainable markets. And now we have the regulation which has to be adopted by the companies. So, and I told you before, the companies have to fulfill some kind of sustainability reporting, but these are not all the companies. At the moment, only a small part of the companies, the big companies and the listed companies, have to fulfill this reporting requirements. But in the future, that will change. A lot more companies will have to fulfill these obligations. And at the moment, and in the past, we had only little information to disclose, or we had some information to disclose, and we will have to disclose more and more information about sustainability in the future. But in the past, in the last 10 years, we had a huge increase in the importance of non-financial reporting requirements. And it was only in 2011 when we started to think about non-financial reporting requirements in the European Union, and started with the Green Paper on the new CSR strategy. And with the NFRD, the Non-Financial Reporting Directive, the NFRD, non-financial reporting was introduced in the European Union, was made mandatory. And it was the biggest change in accounting law in recent years. And we had for the first time to fulfill reporting obligations on sustainability in an extensive manner. But these regulations are at the moment until 2023 under the NFRD, they are subject to interpretation. We have a definition of sustainability and we have some key performance indicators, but we have no concrete indicators which have to be disclosed until the end of 2023. And it starts then with an ongoing process from 2024 with a higher level of standardization, and that specific indicators have to be disclosed. And that's part of the Corporate Sustainability Reporting Directive, the CSRD. So here you can see in this timeline where a lot of actions happened from 2011. Then I told you about the EU Green Book on CSR in the European Union. And we have the first draft of the CSR directive or the non-financial reporting directive. We had a lot of guidelines on non-financial reporting because we did not know how to interpret the regulations of the CSR directive. And we had the frameworks we could use on a voluntary basis, but the annual reports with the sustainable information were not very comparable between the different companies who had to adopt these regulations. And then they decided, resulting from the Green New Deal in 2019, to have a new sustainability reporting in the European Union, no longer non-financial reporting. We changed. We had a switch from non-financial reporting to sustainability reporting, also in the wording switch, but mainly in the content switch. And when we had in June 2022 the agreement on the European level that this CSRD will enter into force. And that's what we have now. We had the draft in 2021, the political agreement in 2022, and the publication also in the end of 2022. And it entered into force beginning of 2023. But the companies have to report according to the CSRD beginning from financial years 2024. So it entered into force 2023, but the reporting obligations will start in 2024 onwards. Okay. So, and what's new with the CSR directive from 2023 in comparison to the non-financial reporting directive from round about 10 years before in 2014. The amount of companies who has to adopt this regulation increases. Before we had only the large companies which had to fulfill the reporting obligations. And now we have a lot of more companies. You read it on the following slide. We have the listed companies, but also listed small and medium-sized companies, and all big companies according to the regulation on the reporting regulations. There is a definition about what is a big company, mid-sized companies and small companies. On these big companies with limited limited liabilities have then the obligation to fulfill these reporting obligations. And the extent what they have to disclose also increased or will increase with the CSRD. The amount of data points they have to disclose, if these data points are material, are more than 1,000 data points, so it get more. We have an audit. In the beginning, a limited audit, but we have an external audit, mandatory external audit for the non-financial information. And we didn't have that before. It was not audited like a financial report because we think that the reliability of audited reports is higher. And to fight against greenwashing, we also want that the sustainability reports are audited. So we trust more in these audited reports, and that's why the reports have to be audited in the future. In the past, that was not the case. The content of the sustainability reports was not subject to an audit. It will start in the future. We had only an audit for the financial reports. And it should get an electronic, an easier access, electronic access to this sustainability reports. And these sustainability reports have to be part of the annual reports of the companies. That could be no separate document. Until 2023, we can have it in a separate document. Afterwards, according to the CSR directive, we have to integrate it in the annual report. And we have also better connection with the financial information and the non-financial information. We should link it to each other. You've seen it before that the revenues, in which part of the revenues results from sustainable business activities and so on. Okay. So then we have the new scope of the CSRD. I told you before, I have it in more detail on this slide. Before, from 2014 onwards, only large companies which were listed on regulated markets within the European Union were forced to report on their non-financial behavior. And now, large undertakings, according to the reporting directive, limited liability companies, like the SE, for example, the European Limited Liability Company, have to report. They have to report from 2025 onwards, and beginning in 2026, small and medium-sized undertakings which are listed on the capital market also have to report. So we have now the large companies which are listed on the regulated markets. Yeah, the big groups have to disclose their non-financial information at the moment, in the past, from 2014, and also in the future. And from 2024 onwards, they have to disclose this information in line with the CSRD. Then in the year after, from 2025, the large undertakings will follow. Around about 50,000 companies will have to fulfill the reporting obligations in the future. 50,000 large undertakings from 2025. And then beginning from 2026, small and medium-sized undertakings which are listed on the capital market. And when we have some more specific obligations for example, insurance undertakings and credit institutions. Okay, so you have the timeline on the bottom of the slide again. And then all these companies who had to fulfill their sustainability reporting in the past, they have to adapt the new regulations from 2024. Okay, here to repeat the main changes in the reporting behavior, 2023 and then 2024 onwards, 2023 before and then 2024 onwards, more requirements, more companies who have to fulfill it, and more higher amount of reporting obligations and of standardization. We are no longer allowed to use any kind of framework to fulfill these reporting obligations. We have the standardized framework, the European Sustainability Reporting Standards, which have to be adopted in the future. From 2023 backwards, we could use any kind of framework we wanted to use. And from 2024 onwards, we have to build on the European Sustainability Reporting Standards, who contain a lot of information about how sustainability reporting should be performed. We have a concept of double materiality, more on another slide. Yeah. And then we have this external audit I talked about before, mandatory external audit for the content of the sustainability reports. And we have an improved accessibility of published information. We have to include it in the annual report, and we should make it machine readable in taking the information. These are the main changes. So, but do we have to disclose? What do we have to report? We have 5 key topics we have to disclose about, and these topics are written down in the CSR regulation. We have to disclose about social matters, environmental matters, employee matters, respect for human rights, and anti-corruption and bribery matters. And then you have in the gray, here in the gray parts of the slide, some examples which could be meant with social matters, employee matters, or environmental matters. And in the past, until 2023, we had, for example, in environmental matters, we talked about waste and energy efficiency, but it was not written down there in more detail which indicators could I use, or should waste be included into the environmental matters, or won't that be important for our sector, for our company, individual company, and the sector we are belonging to. And to interpret that, then I had to go back to these frameworks like the GRI, the Global Reporting Initiative, the standards which were published by the GRI. And about all these matters, these five reporting topics, we had to give some information about the undertaking's business model, a description of the policies, including due diligence processes on the policies, for example, I implemented in the company to reach some environmental goals, or to have respect for human rights, to implement more respect for human rights. What are the qualities behind that? For example, considering the value chain or the business partners in the value chain. The outcome of those policies, the measurement and the results, the principal risks related to those matters, and the non-financial key performance indicators relevant to the particular business. So that's what we try to collect as our tasks for the group work from the annual reports. What are the non-financial key performance indicators the companies detected resulting from these reporting requirements and resulting from their impact, for example, on the society, on the environment, and how also result risks from the environment on the business model of the company. How can I control the company using these non-financial key performance indicators? So that was in the past mostly based on these different frameworks which were used worldwide. The GRI are only one example. We also know frameworks which are used on a national level. In Germany, for example, the NK, Deutscher Nachhaltigkeitskodex, and smaller companies use, for example, these frameworks because they are not that complex. And of course, there exist a lot of companies which do sustainability reporting on a voluntary basis. They also they often use frameworks for that, to identify what are environmental measures and how environmental matters and how can I measure these matters. Even if we talked about some examples before. And now we have the ESRS, the European Sustainability Reporting Standards, which are relevant for the future from 2024 onwards. And the companies work in implementing these standards. They contain 84 disclosures and more than 1,000 data points. And when we have to decide in the first step which data points are material, which one do I have to disclose, and as a result of that, when we have to measure all these data points, to put them together, to link them to the financial information and to disclose them. So a huge part of the work is to identify what do I have to disclose? What is material for my company? How do I affect the environment? How is the business model of the company affected by changes in the environment? And so we have now an overview about the structure of this European Sustainability Reporting Standards. And I have also added some of these examples on the next slide. And I want to go into more detail into these European Sustainability Reporting Standards in the next session we have together. And then you can also have a look into this ESRS and have a look on the structure. We will also do it together then to get an imagination of what the companies have to implement, what they have to measure, what they have to disclose, and how these different data points are related to each other. And then I want to give you some more information about what's going on in the future. For example, 2026, we will have Then also sector-specific standards, because at the moment these are only sector-agnostic standards, and the reporting obligations or necessities for the companies in the different sectors vary from each other. So I want you to look up in the companies in a first step, non-financial indicator you find there. Before we are looking at what's going on in the future and how we want to standardize them in a higher manner, and how we want to concretize these data points and to make it comparable between the different companies. I've given you some examples before in an environmental way. That could be the greenhouse gas emissions, that could be the amount of waste, that could be the composition of waste, it could be the material which is used, the amount of the material which is used in the company, the sources, for example, renewable sources of the energy or fossil fuels which are used, and what is the engagement of the company to improve all these environmental targets, for example, I meant before. But non-financial indicators could also be social indicators that I also mentioned before. You see here standards for own workforce or workers in the value chain, or affected communities, consumers, and end users. The company also affects a broad range of the social community. And then they could also measure their sustainable behavior based on a social indicator, for example, the situation for the workers in the companies. But I want you to collect some of this information from your reports. And after that, I want to discuss your first impressions. And then I want to show some more examples to you. You already have on these slides. If you want to look it up before, and of course you can do that. Because I also collected some examples for you from an environmental perspective as well as from a social perspective, when we will discuss it, and when we can see what will change in the future and how do the companies have to adapt their processes. Okay,